started with budget by the Indian government, which unnerved the bond market, followed by an extremely dovish RBI and a wrap-up of the Indian earnings season. Globally, inflation concern got more serious, and the US Fed kind of signaled that the rate hike could begin from March 2022 itself. Just as Omicron started to recede, geopolitics got sensational with intensifying Russia-Ukraine conflict. We'll take a brief stock of these events and a few more. Russia's military invasion in Ukraine has prompted a host of economic sanctions by the Western world. It first started with a sanction on financial investments, Russian oligarchs, Germany discontinuing Nord Stream 2 pipeline, and then eventually escalated into a large-scale restrictions and sanctions on the Russian banks, including the Russian Central Bank. Several large Russian banks have been debarred from the SWIFT system. It is bound to have implication on global inflation, investments in the short term, and geopolitics, investments in strategic alliances in the medium term. Russia is a major global defense supplier. Russia and Ukraine together are a key source of oil, natural gas, metals, and a select food item. So far, energy supplies have been ring-fenced from the sanction, but the near-term upside to commodities cannot be ruled out. These developments are coming at a time when demand-supply runs tight for many commodities, and commodities have had a good run in prices over the last 2 years. Higher commodity cost further stokes inflationary concerns, which is higher than the desired range for a host of economies. Growth may also be impacted in the near term via trade, sentiments, and inflationary chatter. Now coming to the policy decision. Economic fallout from Russia's invasion of Ukraine could push several central banks to raise interest rates more slowly than previously anticipated. So has been the commentary from a few developed market central banks. As for the Fed, market expects 6 rate hikes in 2022. With geopolitics weighing on growth at the current juncture, we still think Fed may continue with the normalization given that substantial rise in the oil prices is a further inflationary development. And if US Fed continues with the rate hike path, it will be very difficult for rest of the central bankers to ignore the cue. In India, RBI's sanguine view on domestic inflation may get tested with growing upside risks to fuel and consequently core inflation. We have had a more cautious view on inflation, and our projection was 100 basis points higher than RBI even before the ongoing conflict. The government can cut excise duty on diesel and petrol to mitigate the impact of higher crude prices. But if the prices stay above $100 per barrel for a few more months, a piecemeal duty cut will not yield much benefit to the inflation. The budget assumption do have space for such duty cuts, and hence fiscal math stays largely intact despite even if these cuts were to come by. The other impact channel on India are via trade and financial investments. India exports less than 1% of its goods to Russia and largely imports defense equipment from the country. Its energy dependence on Russia is also minuscule. But the risk to India comes from sunflower oil. India imports 86% of sunflower oil from Ukraine, and hence there's a risk to edible oil inflation. And more so, if these conflicts put Europe's growth at risk, it could also put India's export growth at risk. Financial investments into emerging markets, including India, can be restricted as investors turn risk averse. Both these factors could put some near-term pressure on rupee along with the pressure on other EM currencies. RBI's FX reserves should help to cushion some of this impact. Coming to the market, Nifty fell 3% in Feb, in line with US S&P and MSCI EM. The scale of action taken by NATO is likely to determine how much market reacts. market could remain defensive for some more months until the extent of Russian ambition is known and the scale of sanction is better understood. However, if the situation evolves into some sort of stalemate, there is also a scenario in which market shrugs it off and the broader economic influences begin to reassert themselves. India just closed its quarter 3 FY22 earnings season. Earnings were broadly healthy. Companies largely delivered on earnings front despite the rising cost of income. Divergence could be seen between sectors affected by rising raw material prices such as consumer staples, durables, cement, and auto, and those not directly impacted by the rising prices such as private banks, NBFC, and IT sector. But on aggregate, EPS estimates are being met and there are no material downgrades. Recent GDP print at 5.4% for quarter 3 FY22 had underwhelmed, but broader recovery thesis for India remains. Of course, while the domestic fundamentals are in place for a healthy growth recovery, one needs to watch out the geopolitics and other such global developments. Recent correction in market has been small and the valuation premium still remains, commanding near-term cautiousness on Indian equity and a bottom-up stock focus. Now, coming to the debt market, February was a month of two halves, as the budget laid out a significantly higher GSEC supply for FY23 and a scale up to the T-bill supply as well. Yields inched up across the curve by a good 20 to 30 basis points and even more until 9th Feb. This prompted cancellation of several GSEC auctions. But then, extremely dovish RBI in its latest monetary policy on 10th Feb provided some relief to this unidirectional move and led to some correction in the yield. On a net basis, yields have still inched up during the month, and the elevated supply, along with the renewed concern on inflation, could prompt some up moves in the yield before they stabilize or look to correct. That's for this month. Signing off. Take care.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.